Hello students, I am Dr. Nidhi Shankar Singh, Associate Professor of School of Management, BBDU University. Today we will be going through the sources of capital for entrepreneurial ventures, which comes under New Venture Planning and Development. Subject code is NGE 5706. So in this today class, we will cover up the differentiate between debt and equity as methods of financing. We will examine the commercial loans and public stock offerings as sources of capital. Also, we will go through the study of market for venture capital and to review venture capitalist evaluation criteria for new ventures. To discuss importance of evaluating venture capitalists for a proper selection. This much thing we will be covering in today's lecture. So first we will go through that who is funding entrepreneurial startup companies. Firstly, it is the owner's own money. Once they are sufficient with them, they will be trying to start up their companies by their own. If not, then the second one is their family and friends from whom they can ask for the fund to start up. Then there are angels, seed capital, venture capital, bank and government programs, private placements, and last is IPOs. And here you can see in the slide, I have mentioned the amount also. It is in dollar form, that how much we can expect at each and every step, that who can help us in how much amount till the maximum also. You can see that there is no upper limit for the bank and government programs, private placement and IPOs. Else everyone is having the maximum amount also. Till that point they can help us. After that it is not in their hand also. Then coming to debt versus equity. Debt financing is a secured financing of a new venture that involves a payback of the funds plus a fee. Fee means the interest for the use of the money, that at what time period you are going to use it. For as per the time period, the fee is being included. Now, next is equity financing, which involves the sales, means exchange of some of the ownership interest in the venture in return of an unsecured investment in the firm. So there is a very strong difference between debt financing and equity financing. Debt is totally the secured financing and equity is sale or exchange of the ownership interest. Now, from where we will get the help of debt financing? First is commercial bank, where we can make a 1 to 5 year intermediate term loan secured by the collateral. Collateral comes under receivable, inventories and other assets also. But before making that, we have certain questions in our mind. That is, what do you plan to do with the money? That you should be very much clear so that you can explain to the bank employee that for what purpose you are taking the loan. So you should be very much clear that for what is your plan with that money, how you are going to use that, when you exactly what is the time period when you are in need of that, how long you will be using it, and how much time you will take to repay back the loan to the commercial banks. There is a certain advantages and disadvantages both of the debt financing. First, we will go through the advantages of debt financing. There is no relinquishment of the ownership is required in debt financing. Plus, more borrowings are allowed for potential greater return on equity. During periods of low interest rate, the opportunity cost is justified since the cost of borrowing is low. So these are the advantages which you will be getting under debt financing. Now, we will go through the disadvantages also. We have to pay regular or monthly interest payment as per the requirement. Continual cash flow problems can be intensified because of payback responsibilities. And heavy use of debt can be inhibit growth and development. If we are going to use it heavily, then our growth and development is going to be affected. After that, there are other debt financing sources as well. There is trade credit, credit given by the suppliers who sell goods on account, means we are taking something from the shopkeeper and it is on the debt, so that is trade credit. Accounts receivable financing, it is a short-term financing that involves either the pledge of the receivables as collateral for a loan or a sale of receivables at a discounted value, which is known as factoring. Then finance companies, asset-based lenders that lend money against assets such as receivable, inventory, equipment, etc. Other debt financing sources, equity instrument, here give investors a share of the ownership like loan with warrants, convertible debentures, preferred stock, common stock. There are different types of stock which is being given as an equity instruments. Then coming to the equity financing, as I told that the money is invested in venture with no legal obligation for the entrepreneur to repay principal amount or pay interest on it. There, the funding sources are public offering and the private placement. Public offering, we will go through what the public offering is. Going public refers to the corporation raising capital through the sale of securities on the stock market, which I told you, which was on the starting of the slide, that is IPO, initial public offering. That is one of the public offering. There are certain advantages and disadvantages of public offering as well. Advantages is the size of capital amount. It may be large, it may be small, liquidity, value, image, that what's the image of that particular public offering. Disadvantage, we have to pay the cost. There are certain things which are not disclosed. There are certain requirements where we are unable to meet those requirements, and shareholder pressure also over there. Coming to investors, there are different types of investor. First, we will go through the sophisticated investor. Sophisticated investor means the wealthy individual who invests regularly in new and early and late stage ventures. And also they are knowledgeable about the technical and commercial opportunities with the risk of business in which they are investing. Means they are the professional of the field. They have each and every A to Z in-depth knowledge about the field. Then there is venture capital market, under which we will go through the venture capitalists. Venture capitalists are valuable and powerful source of equity funding. Here we will be going through certain points that are the capital for startup and expansion, market research and strategy, management consulting, audits and evaluation, contacts with customers, suppliers and business people, assistance in negotiating technical agreements, help in establishing management and accounting controls, help in employee recruitment and employee agreements, help in risk management and with insurance program, counseling and guidance in complying with government regulations. All this comes under venture capitalist. Then there are certain do's and don'ts of venture capitalists. In do, we will be preparing raw materials before soliciting firms, send a business plan and cover letter first, solicit several firms. We will keep phone conversation briefly. We will remain positive and enthusiastic about your company, product and service. You should know your minimum deal and walk away if necessary. You should negotiate a deal you can live with. Investigate the venture capitalist's previous deals and current portfolio structure. So these are the do's while approaching VCs. And there are certain don'ts also. That expect a response means you can't sit idle and just think that we are expecting a response. You should go ahead and you should search for it. Dodge questions, give vague answers, hide significant problems, expect immediate decision, fixate on pricing, embellish facts on projection, bring your lawyer. Means these are the don'ts. We should not think much more on these points which are mentioned under don'ts. There are certain criteria for evaluating the new venture proposal. The criteria is firstly the entrepreneur's personality. That was the personality, his or her experience, the characteristic of product or service in which they are going to deal with, market characteristic, the market where they will be selling their product and services, financial consideration means from where they have taken help or from which financial institution in a form of debt, and also the nature of the venture team, that what kind of team they are holding, what are the employees, how much experience they are, what qualifications they are having, all these things. Plus, side by side, they are also going through the working environment where the team is working. These are the factors in venture capitalist evaluation process: that timing of entry, key success, factor stability, educational capability, lead time, competitive rivalry, entry wage mimicry, scope, and industry related competence. So these are the factors for evaluation of the process. Like this, we will be evaluating and we will be marking it in a percentage form, that how all the points which I have discussed with you, all those points are here as a criterion, and here it is the percentage. So similarly, we can do it for any new venture. Evaluation process: first we will be doing the initial screening, then second stage we will be evaluating the business plan, oral presentation will be done, and then we will be going for the final evaluation. So these are the screening criteria: venture capital firm requirement, that what are the requirement, nature of the proposed business, economic environment of the proposed industry, proposed business strategy, financial information on the proposed business, proposal characteristics, and entrepreneur team characteristics. So this was all about that, how a new venture capital is going to be done, how they are analyzed, what are the criteria for their screening and all. So we will meet in another lecture. Thank you.